good yourself? Everything's going good. Just trying to get ready for wildland season. Everything's going well.
That's funny, Trustee Santos.
Gotta have a sense of humor. You guys are all sitting like deer in headlights. How you doing, Harvey? He's so laid back he can't even speak. He just waves.
I'm measuring my words very carefully, Dick.
Harvey, real quick, I saw that article in the paper about the crime issues in the
Fool's Day meeting of the San Jose Police Fire Retirement Board is hereby called to order. Let's see. We're going to go into closed session first, and our ever attentive staff has pointed out, and I knew this because I've seen this before, that the way in which we go into this sort of closed session has slightly changed. As you know, Zoom releases an update once a month because the hackers are trying to get into our calls. So they say it may take a minute or two to get into the break room. Let's see. Staff says in the break room on time. Right. So staff, what do we do to go into the break room, the closed session?
Hey, Drew, do you want to do roll call real quick?
Oh, good. Thank you. And just sort of forgot about that. Andrew.
Hi, right here.
Sunita.
I'm here.
Howard.
Here.
Eshwar.
Here.
With all due respect to my good friends Nick and Dick, Nick has suggested that when the sound goes a little wonky, it's not clear if I'm saying Nick or Dick. So if you don't mind, Dick and Nick, I'm going to call you by your last names. Muyo.
Here.
Santos.
Yes.
Sanzeri.
Here.
And we still have a vacancy, right, Roberto?
Yes, we do.
Great. And I am Chair Lanza. Great. Thanks for reminding me, Andrew. And staff, how do we go into closed session? Or are we already in closed session? Or?
No, I'll go ahead and start that process right now. Hold on a
Great.
second.
Somebody hang on while Linda gets us fired up here. before we go to the consent calendar, let's do the orders of the day. We do not have to waive sunshine on anything. I'm going through the orders here. So that's great. No additions, no waiver of sunshine. A reminder that we will do a roll call for the vote. We will go round the circle for comments after long presentations, but by all means, and staff, you too, and you too, Harvey, if it's a temporal question, please ask it. I think it helps us when we do that, and we haven't abused that privilege, so let's go ahead and do that. Does anybody want to pull anything off the consent calendar?
Drew, it's events item
Yeah.
1.3C. It doesn't need to be pulled, but I'd like it to be referred to when our CEO provides his commentary and updates. And he may already plan on doing that, but I'd be curious to know about the presentation to City Council, how that went.
Will do, Trustee Sanseri.
Great, thanks, Vince. Anybody else want to pull anything or make any comments? If not, I'll entertain a motion to approve the consent calendar.
So moved, Santos.
So move Santos, so I have a second.
Second, Sanseri.
Motion by Santos, second by Sanzeri. Let's go around the room. Andrew?
Aye.
Benita?
Aye.
Howard?
Yes.
Eshvar?
Yes.
Puyo?
Yes.
Santos?
Yes.
Vince?
Yes.
I am Trustee Lanza. I'm the Chair Lanza. Woo, special. I get vote yes as well. And once again, for the record, last time we'll put this out, note that we have an absence on the board right now, vacancy. So that's all good. We are humming along. This is going to be a short meeting. They always are right after we approve our discount rate. Prabhu, over to you, 2A, oral update.
Thank you, Mr. Chairman. So what we are going to do this morning is to discuss strategic asset allocation. Again, for the benefit of the full board, just want to let them know that this was discussed extensively at the IC in February, and we also had a special IC in March incorporating feedback from IC members. And Laura will lead this discussion. This is one of the most important decisions that the board can make. As you all know, asset allocation drives over 90% of returns. And it is strategic, so it is long-term. However, things do happen in the market. And because of that, our consultant, Makita, does come up with capital market assumptions on an annual basis. And we use that to revisit SAA and take a look at it. And we have made some small changes, and the IC actually approved a particular mix, and we'll get into that. But before I hand it over to Laura, again, I just wanted to share March numbers. These are pro forma, unaudited and estimates. The pension plan returned 62 basis points in March, and the healthcare trust returned 88 basis points. Fiscal year to date numbers for pension is 17.59%, and for healthcare it's 18.27%. With that, I'm happy to take any questions, Mr. Chairman. If not, we can hand this over to Laura for 2B.
Floor is open. Any questions? Laura, all yours. Take it away.
Good morning, everyone. All right. Can everyone hear me okay?
Yes,
Great. Happy April 1st. I don't have any fancy April Fool's Day jokes planned today. I apologize. My kids have played a couple so far. I have here the strategic asset allocation, which the investment committee has now been through a couple of times. So I'm going to go over it at a high level, but if there are any in-depth questions that you want me to get into, please feel free to ask. So on the introduction here, we, as your CIO noted, we develop capital market assumptions every year. The good news is that your capital market assumption expected return for the long term for 20 years remains above your actuarial assumed rate of return of 6.625% based on our updated assumptions. And that's actually somewhat rare among our clients. Many of our clients are looking at an expected return that's below what they're trying to achieve, and so they're trying to make decisions now around how to adjust asset allocation, just because we are in an environment now with low interest rates and high equity valuations. So a lot of the expectations for long-term returns have come down. So it's definitely a positive that your expected return is still above that level, and that your risk level remains below the 12% threshold defined in your investment policy statement as calculated by Veris, the risk advisor. We've worked collaboratively with staff. What you're seeing here is some options that came out of a long process that looked at lots of different asset allocations, and we've narrowed them down now with the help of staff and the investment committee. And we go through a few different types of analysis, starting with mean variance optimization and also looking at scenario analysis and stress testing. Taking a look at the next slide, the title of this slide should be, your job is harder than it used to be. Because if you take a look at the 80s or the 90s or even the year 2000, you could have been invested 100% in bonds and still met your 6.625% target actuarial rate of return. If you take a look now, the bond expected return is down below 3. The equity expected return has gone from 16.6 in 1980 to 6.4 in 2020. So it is more difficult to achieve a pension fund-like rate of return. We get into, on the next couple of slides, what mean variance optimization is. It's got major flaws in that it assumes a normal return distribution and that volatility is stable over time. But that said, it's still sort of the gold standard for how to start out with asset allocation modeling. And we can tell you that the numbers that it spits out in terms of expected return and volatility are not going to be exactly right. And nobody would stay with one asset allocation for 20 years to find out. But that said, you know, Makita has honed this process over 40 some years and believe that it's a good way of looking at relative differences between asset allocation. Page 5 also gets into sort of how the efficient frontier has shifted downward. Now you need to take on more risks to get the same level of return for each asset class. Slide 6 is the eye chart that is sort of the crux of this presentation because it compares your current asset allocation in the left column to a few other mixes. We've also looked at a 60-40 allocation for your information because everyone sort of uses that as a standard. And then we also looked at what an unconstrained optimization would look like. So if we go into our mean variance optimization software and we say, you know, just give us the most efficient portfolio, you end up with something with 38% in private real assets, 13% in private real estate, 14% in venture capital, because those asset classes, because they take a long time to scale into, do look more attractive to the optimizer. So this is sort of here as on the far right column is an illustration of why you do want to put constraints around your asset allocation. And as you know, your investment policy statement states that we'll do a broad, large, detailed asset allocation review every 3 years. You all have changed your asset allocation just about a year ago. Had, I think, better timing than just about any investor in the market with when you scaled up your equity allocation. So this asset allocation review is designed to be sort of a fresh look at it, but not necessarily, you know, a huge wholesale change. So here we have the current allocation on the left. Our expected return over 20 years is 6.8%, and Veris's standard deviation is 11.7. We see your current allocation as having a split between growth and income and diversification, which could sort of be thought of as an equity bond split, but obviously there's a lot of asset classes that don't fit neatly into equity or bonds. But we think of your current allocation as sort of a 70-30 allocation, and it has 19% in illiquid assets. If we look at mix A, that would have a higher expected return of 7.1%, also a higher standard deviation of 12.8, and more of a growth/income split of 75-25. Illiquid assets would go slightly higher, and so therefore you'd see slightly higher fees relative to the current policy. Mix B has an expected return that's the same as the current allocation at 6.8, very slightly higher standard deviation, and would be expected to have lower fees, mainly because emerging markets equity would go from 12% to 9%. And that's a little bit closer to the MSCI ACWI index, you know, sort of the all country world index has a lower weight to emerging markets than you have right now in your current allocation. If we look at C, you can see that it's a less risky portfolio. It's not expected to meet your expected rate of return, but we wanted to show you one less risky option for your information and consideration. It also would have lower fees because it only has a 6% allocation to emerging markets equity, which is more like how peers of yours report their emerging markets. Mix D was one that was added after some discussion with your stakeholders. And you can see it has a 6.8% expected return, the same standard deviation and expected return as the current mix, but it would have 23% in illiquid assets. Therefore, it would have higher fees relative to the current policy. And one thing I'll point out, the difference here between, say, Mix A and Mix D is that Mixes A, B, and C all have a small weight in commodities. You can see that 2% weight in commodities under other. Commodities are an inexpensive public markets, very liquid way of getting exposure to inflation hedging assets. The difference with Mix D is that it wouldn't have any weight in commodities, but it would put more assets into private real assets and private real estate as a way of trying to protect against the risk of future inflation. However, having more in illiquids would equate to higher fees, and it would take a while to get there. You can see that both the 60/40 here has both a lower expected return, not expected to come anywhere near your actuarial assumed rate of return, and also a lower standard deviation. And the unconstrained mix would have the highest expected return and a more moderate standard deviation that's still above your 12%. But as I said, I don't think anyone would want to invest in this unconstrained mix, nor would they be able to within a period of years, given how much is in private markets assets. With that, I will skip ahead to page 8, which takes a look at.
Question here.
Oh, sure.
Just maybe perhaps a basic question. Is this a industry standard to look at growth and low beta? But I'm more used to a 60/40 equity fixed income, and I just wanted to understand the intuition behind that.
Yeah, that's a really good question, because that is one of the ways that institutions look at asset allocation, and it's usually referred to as a functional asset allocation grouping. There's myriad different ways to look at this. Some folks will look at equity. They'll look at, say, rate sensitive bonds and credit, and then illiquid assets. And then other folks will do this sort of more functional asset allocation. And the goal here is to, as the name implies, look at the function of the asset classes. And so the growth asset classes are intended to have some risk and therefore capture some returns so that the plan can grow. I think, some other folks might name things like low beta or other differently. If you look at how we define the split between, we didn't say the equity bond split, because, someone could say, well, commodities aren't bonds, or, whatever we might be putting in there, or really high yield bonds don't act like bonds. They act like equity. There's lots of different ways that you can consider this. So I would say that this is one way that some institutions, it's not completely unique, look at asset allocation, but there are many different ways to do it. And this was adopted following some of the governance work and asset allocation work a few years ago, this sort of structure.
Thank you. Just one quick follow-up on that. So when I lost my train of thought. Maybe I'll come back later. Keep
Happens
going.
to me frequently on Zoom, so please jump in if you think of anything. Taking a look at page 8, you can see peer allocations. As we've discussed before, take these peer allocations with a grain of salt, because they are self-reported. And everybody, exactly to your trustee's question, everybody defines asset classes differently. So some folks might break out their emerging markets equity like you do. Many institutions include it in sort of just their global equity or their non-US equity. And so here you can see that peers have reported a 5% weight to emerging markets equity. You can see here that there are 58 total portfolios in this analysis, and only 42 reported an allocation to emerging markets equity. I don't believe that means that they don't have any exposure to emerging markets equity, because that would be really unusual for defined benefit greater than $1 billion. I think it's just that those 16 plans don't break it out. And therefore, if they did, that 5% would actually be Taking a look at the next slide, we've shown some mean variance optimization risk analysis. And what we like to highlight here is the difference between the worst case scenario returns among portfolios, the difference between the probability of experiencing negative returns, and then the difference between the probability of achieving your assumed rate of return. And what you see here is, especially the longer period of time that you look at, there's really pretty small differences between these allocations, even though you see a different expected return and standard deviation. So for example, if we look at, say, the worst case scenario returns over 1 year, but they all hover right around 20% down in a 1 year time period. You know, if you take a look at mix C, which was the most conservative, we'd expect a negative return of 18.6. If you look at mix A, which was less conservative, you'd see a down return of negative 21.1. When the plan is down 20%, though, I don't know if we'd notice the huge differences between negative 18.6 and negative 21.1. If we look at the probability of experiencing negative returns in a single year, it all hovers around a little less than a third. If we look at the probability of achieving your assumed rate of return, you see that mix A has the best chance of achieving your assumed rate of return. And what we find with most of our clients is that they typically like to have at least a 50% chance of meeting that assumed rate of return. And I will turn it over to my colleague, Jared Pratt, to go over really quickly some scenario analysis and stress testing.
Thanks, Laura. Good morning, everybody. Yeah, so page 10 here just looks at some negative historical events. They're based on the underlying exposures of each mix to how asset classes inside of them perform for these various historical periods. So the P&F current column, for example, does not represent the plan's actual performance in these periods. It's just based on what assets are underneath that. So on the second line, for example, we have the global financial crisis, and not surprisingly, considering the asset mixes, mix A does the worst, while mixes C and D do the relative best. And that makes sense going back to that growth versus low beta exposure between the different mixes. On the bottom, we have the COVID shock that happened about a year ago. And same example there, not a ton of difference option to option, but the directionality and magnitude makes sense considering the magnitude. And I did want to touch real quick. I know at the last IC meeting, Trustee Menon had a question about the start date on the COVID shock since it started before February in emerging markets. I just wanted to hit on that real quick, that our research team just noted that they like to start everything based on the date that affects the most assets. And so while they agree that January is a better start date for emerging markets, they had to apply the date that affected most assets, and so that's why February was the start date. So I just wanted to touch on that really quick. Here we go the other way with positive scenarios, and this also makes sense. Mixes C and D kind of lag the other mixes considering their asset mix. And I would note mix C is trailing here, and I guess has dampened volatility because of it has the least amount in growth. Mix D doesn't necessarily have less in growth, but the illiquid nature in that portfolio compared to the others, there's less mark to market on those assets, and so a little bit maybe of false sense of dampened volatility versus reality, but that's why mix D shows similar to mix C, despite it having just as much growth as the current portfolio. Moving on to page 12. So this is stress testing, call it scenario analysis, what if analysis. We're basically looking at shocks to the portfolio. And most of these would have a negative impact on the different mixes. So rising rates, falling equities, you can see that there's not a lot of difference between them. And the most significant event that would hurt these mixes are either credit spreads blowing out, they're kind of in the middle with spreads widening, or also equity prices falling quite a bit, they're at the very bottom. And as you know, a lot of times those two things happen at the same time, so that makes sense. Page 13, again, we go the other way here with events that would typically help the plans, the different options. And again, similar results, not a ton of difference option to option. So with that, I'll hand it back to Laura.
Great, thank you, Jared. Taking a look at the next slide, and really actually, oh, go ahead.
On slide 13, so a drop in rates obviously will help the total return of the fixed income portfolio. But, there's been a lot of recent articles and research from, I think, Goldman and Wells Fargo that I saw, which talks about how pensions are reallocating fixed income with the backup in rates. So how does one sort of balance the fact that, a higher rate environment, a lower rate environment would actually hurt us in the future versus a temporary increase in positive surprise in returns?
Yeah, that's a good question because, lower rates generally, have the stock market run a bit. But to your point, if you're an investor in fixed income at all, you're going to get a lower yield in the future. That said, I think if we do have a lower rate environment, I do not consider myself someone who can predict interest rates, and even the best investors in the world have had trouble with that. But if we do have a lower rate environment, I think it's unlikely to be a permanent one or one that's very long term. I think a lot of folks think that rates will rise at some point. But really, given that we don't know directionality in the short term or level, our goal is really just to stay diversified among different risk factors and different asset classes. And that's why, some of our clients historically would say, you know what, why are we even investing in investment grade fixed income? It has such low yields right now. Why don't we go somewhere else? And we've really found that in market shock environments, investment grade fixed income does quite well. And then again, just back to that point of, I think there are, obviously investment managers who it's their job to try to predict direction and level of interest rates. But we don't think anyone is really great at that long term. And so therefore, we just try to maintain diversification in the portfolio.
Makes sense. Yeah, thanks.
And actually, the next couple of slides sort of get to that. If we take a look at page 15, and we look at the sensitivity of the different portfolios to different factors, growth and systemic risk tend to dominate. Surprises in growth on the upside, as you'd expect, mix A with the highest risk profile would do the best. If we look at systemic risk, which is sort of like a global financial crisis or COVID crisis type environment where sort of the whole market is having problems, the opposite is true. You'd have the lowest standard deviation portfolios looking protecting the best. And if we look at changes in interest rates, I think unsurprisingly, the unconstrained allocation that has all private assets would actually, respond the opposite way that rates are going. But all of the other portfolios are really, interest rates changing or surprise in interest rates really wouldn't have that much of an impact on the total return relative to the scenarios where we have a lot of growth or a lot of systemic risk. The other topic that we wanted to discuss along with asset allocation is benchmarking. So when Cortex worked with the boards and the staff to do their governance projects, one of the things that they did was put in place a few different benchmarks to look at for the plan's performance on a relative basis. So we have the strategic asset allocation portfolio and the low-cost passive portfolio benchmark. The idea is that the low-cost passive portfolio is fully investable. So that's why you don't see any sort of peer universes as part of the benchmark there. And so we did a review along with staff to review, these benchmarks were put in place a few years ago. Now the underlying assets and some of these asset classes and underlying strategies have changed. Are the benchmarks still the most appropriate ones? And we found that in 90% of cases they are, but we do have a few recommendations for changes, which are on page 17. The core real estate is currently benchmarked to the NCREIF Odyssey, which is open-ended, diversified core real estate on a net basis. We have found that most other institutions use a market cap weighted benchmark, which is the most common among equity and fixed income benchmarks. The equal weighted really has some dominance of some really small but very high risk funds in that benchmark. So we'd recommend changing it to the cap weighted version, which is more common. We also recommend lagging it a quarter because some of your real estate managers produce lag statements. And so lagging the benchmark a quarter will align that timing with your actual managers. For the market neutral strategies benchmark, we recommend updating the strategic allocation benchmark from T-bills to T-bills plus 1.5. The SAAP to T-bills plus 1.5%, and the LCCP to just T-bills because it's supposed to be investable and you can't invest in T-bills plus 1.5. So if we look at the old benchmark for the strategic benchmark, it's T-bills plus 1. We recommend T-bills plus 1.5 to better represent what's actually in that portfolio. So it would be slightly harder to beat, but we think it's more representative. For the immunized cash flows portfolio, for the low cost passive portfolio, we recommend updating it from T-bills to the Bloomberg Barclays Credit Index, government credit 1 to 3 year. And that would also make it harder to beat, but again, better sort of represents what's in the actual portfolio. For long-term government bonds, there's essentially two benchmarks that are exactly the same. If you look at the historical returns, right now you're using the Bloomberg Barclays Treasury 10 plus. We recommend using the Bloomberg Barclays US Long Treasury, mainly just from ability of data gathering. Your custodian and most market data providers have the Bloomberg Barclays US Long Treasury and not the Treasury 10 plus. So all of these suggested changes are reflected on page 16. And the benchmarks are listed in your investment policy statement. And if you approve these edits, that's where they would be reflected. The next section is on the healthcare trust, but perhaps we should take a pause and turn it over to your CIO or to Veris to talk more about pensions.
Yeah, thanks, Laura. We do have Eileen Neal and Danny Sullivan here. So with your permission, Mr. Chairman, I'd like to turn this over to Veris.
Yeah, hi, Danny. Hi, Eileen. Take it away.
Hello, Mr. Chair. Thank you. Bear with me a moment while I share my screen. Can everyone see that?
Yes.
And can you hear me all right?
Yep.
Okay, great. Well, good morning. And we are going to have a brief discussion focused more on the risk side of the equation of the materials that Laura just presented to you. So as you are aware, there are risk limits within the board's investment policy statement, and those were established through a process where the board and Veris analyzed the relationship between three important considerations: the risk tolerance of the plan, the ability for the plans to withstand volatility and drawdowns, and then the potential impact on the financial condition and plan objectives from both volatility and drawdown. So we'll touch on those in a little more detail in a moment. But in terms of the asset allocation mixes being presented today by Makita, our observations are summarized in a couple of bullets. First, we'll look at the risk limit and compare those to those various mixed alternatives. They all will fall either within the board's risk tolerance limit. However, a couple do fall outside. And that really comes from the higher allocation to growth or higher returning assets. The growth from other assets than equities does increase volatility somewhat, but then on the positive side, we see a reduction in equity beta. We'll talk about that more in a moment. The other key source of risk than equity risk to the portfolio is interest rate risk, and we measure interest rate risk via the duration metric. And when we look at the duration of the various policy mix alternatives, we see that interest rate risk is really not a major risk contributor in any of those mixes. And again, we'll talk about that more in a moment. And then lastly, as we looked at various stress and shock scenarios, and we compare those mixes, risk performance, if you will, within those different scenarios, the outcomes are relatively similar across those various mix alternatives. So with that, I'll turn it over to Danny to just quickly review the risk limit framework.
Thanks, Eileen. Yeah, so prior to diving into the results of the risk allocation study, we wanted to give the board a quick refresher on this risk limit framework. So again, in the investment policy statement, we have several different risk limits defined, one of which that is particularly relevant to today's discussion is this volatility limit of 12%. So we wanted to give a refresher on how the board came to have a 12% limit and the framework that was used to arrive at that. So the risk limits were basically determined over a 9-month period. There was a board offsite. We had several different board meetings. We had individual interviews with each of the board members to try and understand risk tolerance. And then based on all those discussions, we distilled the framework down to these main component parts here. So one is understanding the risk tolerance of the board. That risk tolerance is going to be enforced or reinforced by the relationship, understanding the relationship between volatility and drawdowns, and then further understanding what a drawdown would do to the financial condition of the plan, and then kind of iterating through those three components. So if we move on to the next slide here, so there's a lot going on here, but basically what we're trying to do is identify this relationship between risk tolerance, volatility, and drawdown. So the first column here looks at portfolio volatility. What we're doing is basically just saying, if you take 8% volatility all the way down to 15% volatility, what are the different ways that we could reasonably identify different types of drawdown events? And those are the columns to the right? So there's no industry standard for defining a drawdown event, but these are the most common ways that investors define drawdown events. And so that really depends on the way in which you define a drawdown event depends on your risk tolerance, right? And so we took this information and then we fed it to the actuary and said, okay, well, we want to look at several different scenarios of potential drawdown events from 20% all the way up to 40%, going in 5% increments to understand the impact on several different actuarial metrics. So if we go to the next slide, that's what we did here. And so we have two different tables here. The first table on the top looks at how bad would it get in a single year if we had these varying levels of drawdown events. And so let me just run through really quick. So baseline, if we look at the baseline scenario, that assumes that all of our actuarial assumptions hold true. What this is saying is how low is our funding ratio going to be in a single year over this entire period, right? So your baseline assumes that today is your worst because your funding status improves through time. And then what's the most you would pay in city contributions? And then what we show in the columns to the right there is under these drawdown events, how bad would it get in an individual year? The table below the single year is a 10-year cumulative, and this looks more at the entire impact of a drawdown event because as we know, losses are amortized, they get smoothed over longer periods of time. So the entire impact of a drawdown happens over several years, not just in 1 year. And so we look at a similar thing here, what we're showing is at the end of a 10-year period, what would your funding ratio be? How much would the city have paid in contributions? And then over that 10-year period, at the very end, what would your funding ratio be? And how much more would you have paid in city contributions under these different drawdown events? So we went through this exercise with the board. This was several years ago now. This was, I believe, 4 or 5 years ago. We've discussed that this is probably worthwhile to go through this exercise again. But what we determined was with the board was the 25% drawdown number. We could reasonably infer a 12% volatility level from that. And that's how the limit was set. So from there, we can move on to the actual results of the risk allocation study.
Thank you, Danny. So on this slide, we're looking at the volatility of the various mix alternatives compared to the current policy mix, which is the left-hand most bar. I will say that the way that Varus calculates volatility is using our risk analytics and in our risk allocation study process is different in that typically in an asset allocation process, risk or standard deviation is simply the deviation of historical returns. But the approach that we take is essentially a building block approach where the volatility is an aggregation of the underlying exposures within the various portfolios that is focused on a shorter time horizon and actual market volatility. So with that in mind, I focus on the 60/40 and the unconstrained as being sort of the two most differentiated policies relative to the current policy and the remaining policy mixes. And what's interesting is that the unconstrained, even though it does have a much higher exposure to illiquid assets, does have a higher volatility, but it is actually modestly when you look at roughly a 60 basis points difference between that and the current policy. And then likewise, the 60/40 is not surprising that you would expect to see lower volatility given the higher exposure to fixed income. But the variation across the remaining mixes is really relatively subtle. Another way that we evaluate the asset allocation mixes is through looking at the contribution to risk from the main factor exposures of the underlying assets. And so, what we saw on the Makita slides was the capital allocation to asset classes. And on this slide, slide 7, we're looking at the risk allocation to the main risk factors, and those risk factors being, as you can see in the legend, rates, credit, equity, et cetera. So again, what is notable is that no matter the equity capital allocation, the contribution to risk from equities is much higher than that capital allocation in any of these mixed alternatives. Interestingly, if you look at the 60/40, which is the second bar from the left, even though it's 40% bonds, the contribution to risk is highest from equities in this particular policy relative to the others. And that's because there is a lack of other assets to offset that equity risk exposure as we see. In fact, that's most notable in the unconstrained policy, which has the lowest contribution to risk from equities because there are a greater exposures to more diversifying assets such as currency exposures from global assets and inflation hedging or real assets. But as far as the other mixes go, the contribution to risk from equities is fairly similar to the current policy portfolio. And the red diamonds represents those volatility numbers from the prior slide. Another way of examining the various policy alternatives is to look at the sensitivity of those policies to equity beta. So what that sensitivity tells us is the degree to which we can expect our policy mix to perform in particularly outlier equity market environments. So again, while the scale is a little bit drawn out, I will emphasize that the distinctions are pretty minor. We go from, basically a 0.6 to a 0.7 if we round. So again, shouldn't read too much into the visual distinction between these bars. All of these mixes, as we just saw on the prior slide, because of the high contribution to risk to equities, have meaningful equity betas. the mix A probably would be the least desirable because it has the highest equity risk exposure. And as we saw from Makita's slides, not that much more of a beneficial return relative to the current policy mix. Conversely, the 60/40 has the lowest equity beta, again, because of the higher fixed income exposure, which does offset some of that equity beta. So even though the contribution to risk in the 60/40 mixes from equities is high, you do benefit in these periods, particularly in a drawdown period, from that lower equity beta. The other key risk exposure in any balanced portfolio is interest rate risk exposure, which is measured by duration. And here we're looking at the duration, both in terms of interest rate risk and credit spread risk. So effective duration and credit spread duration. And you can see in all cases, it's relatively low, the unconstrained being probably the highest duration risk exposure, because there we have that very large exposure to long government bonds. But duration or interest rate risk and credit risk exposure is not a meaningful, or not as meaningful as it is in other portfolios. We looked at scenario analysis, compared the mixes across the scenario analysis, and really don't see a lot of distinction. The two scenarios that would be the most worrisome are the 2000 to 2003 tech crash and recession environment, and then of course the 2007-2009 subprime and credit crisis. Those are the two environments that in the future we would like to see some amount of protection against. And the only portfolio that provides a really meaningfully different experience, at least in the 2000 to 2003 environment, is that unconstrained portfolio. And it really is, I think, more a function of the fact that the illiquid assets wouldn't write down at the same time, and maybe not to the same degree as the public market assets, particularly if there's a high real asset component. So, that scenario shows that, greater illiquidity, particularly in the real asset space, is a potential benefit in these drawdown environments. And then here we're looking on slide 11 at various what ifs or stress tests. So the point we made earlier about duration risk being not very meaningful, if we look at the global credit spreads plus 100 basis points, you can see the potential drawdown risk there is very muted. Same is true if we saw a commodity sell-off, the one exception being that unconstrained portfolio, which not surprisingly has the highest inflation hedging exposure and potentially the greatest exposure to commodities relative to these other mixes. But the only real serious drawdown scenario or what if scenario would be if global equities were to sell off, because of the fact that the contribution to risk is so great across these portfolios. And in that environment, we don't really see a meaningful distinction in terms of potential outcomes, with, again, the exception of maybe the unconstrained portfolio drawing down maybe 1% or so less. And then lastly, we looked at the COVID shock environment. Now here we did go back to February. I thought Jared did a nice job explaining that while some entities might look back at January because of what was going on in emerging markets, we too have tended to focus on when the US markets predominantly began to draw down. And again, across these various mixed alternatives, you don't see a really big distinction in terms of performance differentials. Maybe mix A being the outlier. So, you know, when we aggregate all of these analyses together, there isn't a compelling reason, in our view, to move away from the current policy, particularly in light of the fact that it was just adopted about a year ago or so. So I'd like to pause there and see if there are any questions.
Floor is open. Go ahead, jump in if you've got any questions for the Veris folks.
Happy to jump in if nobody else wants to go.
Sure. Go ahead, Sonia.
So terrific presentation, both you guys and Nikita. I just wanted to make sure I'm understanding the definition. What do you mean by a drawdown?
So a drawdown is simply an environment where we have a very large sell-off. You know, generally that would be in excess of a 10% negative return. So you know, within negative 10% returns and higher, that's considered sort of a normal experience for a portfolio that's diversified like your portfolio and other balanced portfolios. But once you get beyond that 10% negative return, then that's considered a meaningful, drawdown or deviation away from what we would expect to see.
So it doesn't have anything to do with our revaluing our liabilities at that point. It's more of a generic market term.
It's completely market related only, correct?
Okay. So then if you can go back to slide 4, or was it 4 or 5 actually, 5. I thought this was really, really well done. So when you say a negative 20%, for example, in a single year, that's a negative 20% return on the portfolio, or a shock of all the variables that contribute to the funded ratio?
So it's a negative 20% return. And at that negative 20% return, you could see the distinction between that and the baseline impact on, say, the funded ratio and how that would flow through potentially to contributions, right? So that's the impact on the funded status and so forth that you see is associated with a 20% negative return or drawdown.
Is that 20% relative to our base case assumption? Say the 6 3/8 or whatever it is right now.
No, it's a 20% absolute. So just negative 20% as opposed to your baseline assumption being the 6+%.
And one last question.
Sure.
Which was on the stress testing on the dollar appreciation. I guess I was a little surprised to see such a big impact, negative impact to the portfolio. Can somebody perhaps enlighten me?
Yeah, so a couple of things. Number one, it's a negative impact because the assets are unhedged. And so if this is a dollar increase, right, that you're referring to, or are you talking?
Yeah, I was just surprised that an appreciating dollar could have up to a 6% negative return on a domestic pension fund.
Right. Well, it's domestic, but you do have a fair amount of allocation to non-US assets, both on the public market side and to some degree on the private market side. And when the dollar appreciates, that's bad for you as a US investor in non-US investments if you're not hedged. That does have a negative impact. But that said, because that drawdown would be less than negative 10%, we would not view that as being really meaningful in the big scheme of things. It's well within what we would expect to see in any one year in terms of performance away from our expected return, if that helps.
That helps a lot. Thank you. That's all I have.
Thanks, Sunita. Any other questions on the presentation? If not, we'll have a chance to discuss more broadly. Howard, go ahead.
So I was going to ask questions going back to Makita. Should we? Are we?
Yeah. Hold that. Yeah, hold that till we open up. If this makes sense, let me go back to you, Prabhu, to kind of wrap it up, and then Eshvar, I'd like to go to you first since you're chair of the investment committee. So, Prabhu, do you want to kind of wrap it up? Is there something more to present?
Yeah, thank you, Mr. Chairman. So this is really, Veris's analysis on the various options that we did. So I'm just, with your permission, I just want to hand this back to Laura for a quick minute in case she has any concluding remarks. And there are some specific approvals that we will need from the board after your discussion and analysis. Thank you.
Back to you. Go ahead, Laura.
Thank you. Yeah, I would just take us back to page 6 for just to have on the screen as we discuss and just point out again that that mixes A, B, and D all have an expected return above your current assumed rate of return. That all 3 of those mixes, actually A, B, C, and D, all have a standard deviation under the 12%. Mix A does have a higher one. That also another difference is, as I pointed out, the commodities exposure of 2% in mixes A, B, and C, and also the emerging markets equity exposure that with mix A is the same as the current and then scales down with mixes B and C. So we are happy to take any questions on these comparisons.
Great. Eshvar, do you want to sort of weigh in? Either maybe you go first asking questions, Eshvar, if you want to sort of summarize from an investment committee perspective where you think we are.
Yeah. Thank you, Drew. So just in terms of, first of all, thank you to Prabhu and the investment staff. Thank you to Makita, Laura, and thank you to Eileen and Veris for all the work. As Drew said, as Prabhu said, I think we took 2 meetings and went over a lot of things. And our starting point is a current mix, and the thing that we asked ourselves is there a way in which we can improve this, either by getting higher returns and or reducing the risk to the portfolio. And we considered the comments that other trustees have expressed before, including the members of the IC committee, in terms of some of the risks that we were taking, particularly in the public equity side, where it looked like relative to the benchmark, the public equity benchmark, ACWI, and relative to a peer group that maybe we had more emerging market exposure. And we said, well, is there a way in which, the long-term returns don't suffer, risk metrics are still fine, and we can keep the, and we can bring down that exposure. Now, if you look at the mix, the different mixes, mix A, as Eileen pointed out, the risk parameters are higher than what a threshold is. But one of the comments that did come up was maybe if there is a future drawdown, that we look to maybe increase our growth exposure, maybe not in the specific way that mix A has, but something on those lines. But right now it doesn't meet the constraints that we have in terms of what we're trying to do. Mix C has lower returns, as Laura pointed out, relative to what our target is. So it came down to the current mix versus mix B versus mix D. And both mix B and mix D kind of reduce that emerging market exposure. And the difference between those two, and I think this has been touched upon, is I think mix D has a higher private market exposure. Mix B has slightly lower and has that commodity exposure. And we debated it. There were some differences of opinion, but the IC committee ended up kind of saying that maybe mix B is what we would recommend to the full board.
Great. That's exactly what I was hoping for, Eshvar. That's a great summary. Let's go ahead and then go around table. Andrew, you got anything you want to jump in with?
No additional comments besides what Eshwar just summarized. Good job. Thanks.
Great. Sunita, any comments or questions you got?
I'm sorry, is it B for boy or D for dog that you're recommending?
B for boy.
B for boy, okay. No comments.
Great, thanks. Howard, go ahead. Why don't you jump in now?
Yeah. First of all, thank you, Laura and Eileen, for Makita and Varus respectively. I thought these analyses were very good. I like the scenario analysis, and I actually like the idea of looking at B and D and C compared to the current. And when I looked at all those scenarios, I really it was hard to choose for me between B and D, and it all came down to I guess what our view is of the next 18 months. And I know it's hard to do, but if you look at whether we see interest rate risk or inflation risk, that might tip the scales to B or D. But it was a good review. I think it all depends on how we view that. I had one technical question on this slide. Laura, maybe you can help me out. Is the fees, when it says higher fees relative, and that means the returns are net of fees? If you have that row on either 10-year or 20-year returns, those are net of fees?
The returns are net of fees for asset classes where there's no passive option like private markets or commodities. So that's a great point. One could make the case, I think, very valid, that we shouldn't be thinking about fees because we should just be thinking about net returns. If you're going to get paid for taking the fees, then why should that matter? However, as we've, I think, all seen, press and board, and city council and other attention, it does seem like the absolute number around fees is very important to some stakeholders. And so that's something that we wanted to point out, even though I think an investment professional might say, well, as long as you're paying for your fees by returns, that shouldn't matter.
Yeah, that makes sense. And I guess going forward, in terms of our allocation, we're on a 3-year plan. And, last year, the staff and the committee and Prabhu took the action to move forward very swiftly, which was a great move about a year ago, maybe a little less, with the shock. How do we view standard deviation in terms of is there a way of looking at standard deviation to give us a clue as if things creep towards 12, that maybe we should make a decision on allocation? This is my first year here, so I don't, just wondering what would be a good way to look at the future given the data that we have. So maybe we would shift to another allocation. That's it for me. Thank you.
Yeah, I don't know if Varus wants to comment on the standard deviation. It's difficult. Everything is going to be backward looking. And, standard deviation isn't necessarily a bad thing if it's happening on the upside. But I'll also defer to Varus.
Thank you, Laura. And Trustee Lee, we are, Varus's role as risk consultant is providing regular, on a quarterly basis to the board investment committee, risk reporting, where we are in fact looking at today how the portfolio's volatility compares to that limit, as well as to the expected historically return-based standard volatility. So we are, in fact, if you had compared last year's presentation when the asset allocation was changed, you would have observed at that time that the standard deviations were pretty different, about 1.5% different from what we're presenting today, and 1.5% lower at that time, actually, because of the fact that we're here a year later and volatility has remained heightened or elevated across capital markets.
Yeah, and if I might just say something, I think the 12% is something which I think it predates me being on the board. But I also know that there are other public funds with much higher numbers, if I'm not mistaken, in terms of what the maximum allowed is.
Yeah, if I can just jump in real quick, both to the question of Trustee Lee and the comment made by Trustee Menon. Yes, so if it comes close to 12%, Trustee Lee, we will, if nothing else, report back to the IC and have a discussion. And as Trustee Menon pointed out, the 12%, this was based on a study done about 4 years ago, and it's very San Jose specific. Obviously, we have some very specific considerations at San Jose based on our funding ratio, the impact on the city's budget, and also in terms of just tier 1 versus tier 2 assets and liabilities. So so Beres did a study about 4 years ago and came up with that number. And as Eileen pointed out at the IC, it's probably time for us to revisit that 12% number, and we probably will do that in conjunction with the IC at some point.
Thank you.
Great. Anything else, Howard?
No, that's it. Thank you.
Great. Muyo, Nick, you want to weigh in with anything?
No, thank you for the presentation, folks. Appreciate your work.
Santos, Dick, you want to weigh in with anything?
Everything is fine, thank you.
Thank you. Vince, anything you want to jump in with? You might be on mute, Vince. Vince, anything? You're on mute, Vince. I can't hear you. Okay, now I see your mute icon. Now I don't see your mute icon. Say something. No, okay. If you get that fixed, Vince, go ahead and jump in. So I'll go ahead and jump in. There's some historical perspective here, and I could not possibly put in words how enormously proud I am of the work of this board and the work of the staff and the work of our consultants. Let's take a step back and look at what we've just done, which I think may not be unique in pension funds, but boy, if it's not, it's certainly rare. So we said when we tried to figure out how risky and therefore how large a reward we should get, that there were two ways to sort of pick risk. The first, the easiest, was sort of grading on a curve. Our actuary says we probably are more impacted by risk because of the leverage ratios we've all looked at before, and therefore grading on a curve, we should probably be less risky than other pension systems. And so we sort of took a classic a horse and cart approach to that. We started to lower our discount rate. Well, okay, let's put a lower discount rate than other pension funds, and then build an asset allocation mix to match. So that was actually pretty good. We may have overshot that and been a little more conservative than we need to, but it was Vince, I think, who really said, let's do the heavy lifting and grade absolute. Let's actually figure out what risk level the city could actually tolerate. And we've asked the city many times to answer that question. And I think the fact that they don't answer that is partly because it's almost a deeply, almost religious level philosophical question. Also because I don't think cities are generally asked this. And of course, also because ultimately it's really our responsibility. But what you just saw, folks, is deeply, deeply profound. This board is now able to say, look, we're going to pick this level of risk because to this probability level, the city will suffer this kind of impact. And we've dug a little deeper. As Vera said in the offsite, okay, well, what kind of shock could the city tolerate? So I think this is the highest level of pension planning, which is to say, no, let's not pick a discount rate or portfolio based on what everybody else does. Let's pick a portfolio and therefore a discount rate based on probabilistically what can the city withstand. Because of course we could stick it under a mattress, but then that would bankrupt the city. And we could invest it all in very high risk stuff, But of course, if that went south, as Eileen showed us, that might bankrupt the city. And so, just like Goldilocks and the Three Bears, the answer is somewhere in between, not too hot and not too cold. So, Eshwar, do you want to go ahead and make the motion?
Yes. So I'll make a motion that we pick mix B.
That's great. Do we have a second for that motion?
Santos.
Second by Santos. Great. Any discussion on that?
Council,
Can I ask a question?
Sure, go ahead. Go ahead, Sunita.
So I know that the material difference between the current and mix B is a commodity allocation. So has the investment team invested in this asset class before, and what is the sort of experience around it?
Yeah, thank you for that great question. And the answer will be, about an hour long, so I'll keep it short. We have invested in the asset class before, and there's actually a lot of history there, and I can discuss offline with you. But at this point, we are looking to get some quick passive exposure to the asset class.
Or is it your team essentially driving the process?
Sorry, you cut out. What was the question?
You said you have experience in the past, so I'm assuming it's your team driving the process, or are the consultants involved in that?
Well, we have invested in commodities before, and it's always a joint effort between the investment team and our consultant in picking managers and in how best to get the exposure.
Yeah, I think if I may add something, Prabhu, here. So
Sure.
we did have a discussion on that, Sunita, and I actually asked a very specific question. This is the IC that you asked, whether this is the best way of expressing maybe some inflationary concerns, and the alternative was that many asset classes actually do well under inflation pricing power, right? I mean, you could be in real estate, you could be in real assets, even equity, right? But I think the feedback from Prabhu, and I think some other IC members is the view as a little bit tactical, maybe benefit from the current environment, and we revisit it in a year and see if it still makes sense, whether that 2%, tactical allocation makes sense.
I thought we shy away from tactical allocation, and commodities have run up a fair amount. So, but anyway, I'm sure you guys dug into this, and I see. I'm not trying to regurgitate your discussion. I just wanted a high-level understanding.
Yeah, if I can just quickly add to what Trustee Menon said, we did discuss this in depth, and it's not just from a return perspective; it's also a diverse reasons why the current asset allocation was also an option and on the table. So I think I view commodities more as from a diversification point of view. It helps reduce risk, and we can get low cost access to the asset class.
Yeah, I would just add, if we look back at historical scenarios, if we look at 1994, when there was an interest rate spike, commodities were up 17%. So I think, having a small allocation in that asset class is just a diversifier to try to protect against a scenario like that.
Can I assume that commodities don't include crypto? Is that exclude? Okay, thanks. I'm good, Drew.
Okay, thanks. Hey, Roberto, did I hear you jump in there? Is something you want to weigh in with?
Yeah, no, just quickly, it's pretty clear by the discussion now that the mix that is being recommended in the motion is mix B as in beautiful. I just wanted to make sure that everyone is clear and there's no misunderstandings. I know they have been asked before whether it's B or D. And so again, I just wanted to make sure that it was understood for everyone, stakeholders and you trustees, when you approve the motion that is B as in beautiful, mix B, the one that is being recommended. Thank you, Mr. Chair.
Yeah, that's super helpful, Roberto. Zoom, the wonders of our consonants under Zoom. So as Roberto says, it's mixed B as in Baker. The motion was by Trustee Menon and a second by Trustee Santos. Let me go from the top again. Andrew.
Aye.
Sunita.
Aye.
Howard.
Yes.
Ashvar.
Aye.
Muyo.
Aye.
Santos.
Yes.
Sanzeri. I heard him. He's giving us a big thumbs up, folks. That vote can't count, but just for the record, he gives us a big smile and thumbs up. I vote aye as well. So that carries. Really sincerely, guys, this is a big damn deal. And thank you to Varus, and thank you for Makita for coming with us on this multi-year trek and odyssey. I see smiles coming from Eileen and Laura as well. So Laura, get back there and now prank your kids.
Yeah. Well, we still have to talk healthcare, but I also wanted to mention that, I'd really credit, you had mentioned how effectively the plan pivoted, and that was, from our perspective at Makita with, 200 some institutional clients. I think you all definitely win the award for best timing, and I'd really credit the staff and your CIO and your board for, especially some members of the board who've been there a long time, and you've seen all the, low risk environments and some of the, maybe less effective tactical decision making. You all had said you'd re-risk it at the appropriate time, and you did, which is quite rare among institutional boards. So congratulations.
Thank you, Laura. That means, coming from you, that means a lot to us. You've been down in the trenches with us plenty, so that's awesome. Prabhu, over to you. Anything to wrap up your section with?
We do need 2 more approvals, Mr. Chairman. So we've the asset allocation for the pension plan. We do need an approval for slide 16. If we can get to slide 16. This is the revised benchmark.
Oh, right. Sorry, that's right. And then what's the third approval on?
And then healthcare. And I'll turn this back to Laura to discuss the healthcare allocation.
Great. So
I'm being a little bit. Hang on, Laura. I'm being a little bit sloppy here. How would you like to take that? Would you like to take the vote and then Laura and then the vote, or how would you like to do it, Prabhu?
Yeah, I think that will be better, Mr. Chairman, if we can just vote on the benchmark and then move on to healthcare.
So, Ashwar, would you like to make a motion on this benchmark?
Yes, I propose that we adopt this new benchmark.
Great. Is there a second to Ashwar's motion?
Second, Santos.
Second by Santos to accept this. Let's go around the table. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Ashvar?
Aye.
Muyo?
Aye.
Santos?
Yes.
Vince?
Aye.
Aye. Ooh, he's back. Good. And I vote aye as well. No, great. So back to you then, Laura, for the healthcare trust. Sorry for skipping that. It's such a small thing. I always forget.
No, not at all. And that's actually one reason we wanted to put it in the same presentation and discussion as the pension, because I think we all focus on the pension, and the healthcare obviously is much smaller. And so last year, when in the early days of the pandemic, when we were all very focused on adjusting the pension allocation, which obviously panned out quite well, we didn't at the time adjust the healthcare allocation. So it is still sort of using a prior strategic position where there used to be a lot of short-term bonds in the portfolio. So we wanted to try to recommend updating it so that it sort of conforms to the strategy that you're using now on the pension portfolio. So if we take a look at slide 19, you can see the current healthcare allocation, and you can see in almost a third of the healthcare plan in short-term investment grade bonds. The pension used to have a lot of investment grade bond or short-term investment grade bonds a couple of years ago. It does not anymore, and so we'd recommend shifting some of the short-term bond exposure to investment grade bonds and some long-term government bonds, similar to the strategy that you use in the pension. So you can see here also that your healthcare expected return now is 6.25%. The current healthcare allocation, we would not expect to earn that 6.25% over the long term, if we look at mix A, it would be expected to earn in excess of your actuarial assumed rate of return. I know we've talked about this in the past, but just as a reminder, historically, your pension trust and your healthcare trust have had the same expected return. And therefore, the healthcare trust has needed to be perhaps a bit more risky than the average healthcare trust in order to try to achieve that rate of return. Now, those the board has voted to have those returns diverge, which allows you to not necessarily need to take on as much risk as you do in the pension in the healthcare. However, the fact that we're not using illiquid assets in the healthcare trust, mainly because there's a lot of volatility in some of the contributions and distributions from the healthcare trust, we avoid illiquid assets. Using fewer asset classes necessarily sort of raises the standard deviation because you lose that free lunch of diversification to lower your risk. So if you take a look at the healthcare current allocation has 56% in growth assets, 29% in low beta, and 15% in other. It does have core real estate and commodities. So, you know, this is one area where the staff has experience investing in commodities since it stayed in the healthcare trust the whole time. Mix A would raise growth assets very slightly, would raise US equity by 2% and developed markets non-US by 1%. So growth equity would go up to 56. Would take short-term investment grade bonds down to 5 and reallocate some of those assets in short-term investment grade bonds into market duration investment grade bonds, which typically have a duration around, say, 6 years, and long-term government bonds, slightly increase core real estate by 2% and keep commodities where they are. Looking at mix B, it would be a bit more conservative. It would actually lower growth assets by 1% and have 20% in investment grade bonds. Mix C would be even more conservative with growth assets at 50 and investment grade bonds at 25. And one of the reasons we're showing you a couple of more conservative allocations here, if you want to skip ahead, Jared, to page 21, is that if you take a look at the peer health and welfare universe, again, grain of salt because peer reported, self-reported, but you can see here that the median equity weight is below 30%. So, so traditionally, healthcare trusts have had a very conservative asset allocation. So we wanted to show you back on slide 19 a couple of conservative asset allocations. We're showing the Makita standard deviation here. There's no guideline in the investment policy statement as to what the risk limit should be for the healthcare trust specifically, but you can assume that the VERIS calculated standard deviation would be below these Makita numbers. So mix A here would be assumed to earn your expected rate of return and have a standard deviation below 12% if VERIS were to calculate. Alternate, or actually, let me skip to page 22 really quickly, just again to look at worst case scenario returns, the probability of experiencing negative returns, and the probability of achieving a 6.25%. I just highlight that mix A is the only allocation here that would achieve have a 50% probability just about of achieving your expected rate of return. And Jared will just go over the scenario analysis and stress testing.
So yeah, just looking at these real quickly, probably not surprising, similar to the pension plan where mix C is the most conservative and so looks you know, the best in these drawdown scenarios. And then when we go the other way, mix C is what's lagging the others, and mix A does the best in these upside scenarios. To touch on some stress testing really quickly, fairly tame numbers, really. Again, it's the credit spreads blowing out or equity selling off that are the two events that would have a dramatic impact on the actual return. But similar numbers, really, option to option. And then I'll wrap it up here on page 26. Really similar story again, but mix C is the laggard in these environments where that would have positive influence from a return standpoint. So Laura, I'll hand it back to you.
All right. So we have economic regime management again on page 28. And the growth and systemic risk scenarios remain the dominant ones in terms of impact on the portfolio. So in a growth environment, you know, a 60-40 with the most assets and equity would be expected to perform the best, followed by mix A. Similar in a systemic risk environment, mix A would have the most downside risk. If we look at interest rates, the 60-40 has 40% in investment grade bonds, so more impact from interest rates than mixes A through C. So just to summarize, we would recommend considering an update to the healthcare trust asset allocation to align better with the strategic positioning of the pension plan. And if you take a look back at page 19, I'll just end there on this discussion.
Good. Back to you, Prabhu.
Yeah, thank you, Mr. Chairman. Thank you, Laura. So we did discuss this at the IC. I don't believe the IC recommended a particular mix, though based on the discussions, I believe the IC was leaning towards mix A, and the fact that we've not done a refresh of the SAA for healthcare trust in a while. So I'll let someone make the motion, or, of course, certainly happy to take questions.
Yeah, Ashwar, again, for the third time, why don't you go ahead and make the motion for us?
Okay, Leah, we recommend mix A for the healthcare trust.
Great. Do we have a second for that motion?
Second, Santos.
I have a motion by Ashfar, second by Trustee Santos. Any discussion on that?
Optics of reducing emerging market equity in the other portfolio and not on this. Is the board comfortable with that, I guess? Keeping it constant here.
Yeah, I just, deferring to the board, of course, but I'd mentioned that it's really hard to get a return of above your 6.25% using all public assets without a pretty hefty weight to emerging markets equity, just because it's the highest returning public markets asset class in terms of our forward-looking expectations.
Why would you just not increase U.S. equities? I'm not saying you shouldn't increase equities.
Yes, you could do that as well.
I'm just wondering about, the different parameters that we are using for one portfolio versus the other. I understand this is a much smaller portfolio, but.
Yeah, so our expected return forward looking for US equity is 7.4% per year, and for emerging markets equity is 9.1%. So you'd need to shift both from emerging to US and then also increase growth as a whole and equity weight in order to still hit that 6.25.
Yeah, I think, Sunita, one thing is that, because we don't use private markets here, and the asset classes which give emerging market like or even higher returns are, things like private equity and venture capital, which we don't have access to.
Yeah, that's a fair point. So you want some other higher beta exposure. So.
Yeah.
Okay, fair enough. I buy that.
Any other questions before we go around the room to vote? Around the Zoom. We're going around the Zoom to vote. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Ashvar?
Aye.
Muyo?
Aye.
Santos?
Yes.
Vince?
Aye.
Chair Lanza, I vote aye as well. Prabhu, does that take us all the way home? More to do, more to talk about? What do you think?
Thank you, Mr. Chairman. I think that concludes it. I just, for the record, want to thank Laura and Eileen and Danny and Jared, both Makita and Veras, for all the help and the hard work. We started this process at the end of January. It's taken us 2 or 3 months. And as I shared with the IC, there were probably days when Laura thought that San Jose was her only client. So I on him a lot. So thank you both to Veras and Makita. And I just got a note from my good friend, Mr. Pena, who was wondering whether the fiscal year-to-date return that I shared was not an April Fool's joke. And I can assure the board that it was not, though anything can happen between now and June 30th. With that, Mr. Chairman, we'll conclude the investment section. Thank you.
Thanks so much. We don't have any old business, so section 3 is empty. That happens from time to time. Roberto, over to you.
Thank you, Mr. Chair, and thank you, Prabhu, for sharing the offline email that I sent you. So, no, great.
As Harvey would tell you, Roberta, nothing's offline.
Very well. So if you bear with me, I do have a couple of updates, and I'll finalize my comments with the comments on the evaluation presentation to the City Council, which I intended to do anyway, but per request of Trustee Sunseri. First and foremost, let me remind everyone, if you have been able to file your Form 700 already, thank you. If you haven't, today is the last day, is due April 1st. No joke about that. If you do have any questions about filing the form, please feel free to reach out to Council Lideman, who is available to answer any questions regarding the filing of Form 700. So staff, as you may know, has been working with the city clerk, and I have updated you the last couple of months. The city clerk did open the process for the applications for the retiree seat that is currently occupied by Trustee Moya. So thank you, Nick, for your willingness to continue serving. So that's one. The other one is the police active seat. We're still working with the city clerk. My understanding is that they have been already 2 applications, one for the retiree seat and one for the active. We're working with the city clerk to confirm that, and we will keep you posted. If in fact there were applications that were received and the process ends this month, we're hoping that you can have both seats filled by your June meeting. Interviews for the 2 open positions at the benefits area for the senior benefit analyst and benefit analyst positions have been scheduled. In fact, for the senior benefit analysts, they were performed, and we are actually right now going through the selection process. The interview process for the benefit analyst position is scheduled for next week on Monday, April 5th. The quarterly ORS newsletter is expected to be issued in the next couple of weeks, so you'll see a copy of it on your next board agenda. You may recall that at the last meeting, the fiduciary insurance, which are 3 different kind of insurances, were approved by your board, and the $75, which is actually comes out to $25 for each insurance, is due at the end of the month. So you feel free to send a check made out to the retirement office, to our office. So we will follow up as a reminder with emails. I also wanted to let you know Medicare Part B reimbursements are going to be paid out, hopefully most of them this month. So we'll probably take the checks of April and May to be paid out. So far, we have received about 500 applications. The information to request the reimbursements is actually due today, April 1st. The initial letters went out to all the members, and these are members from the police and fire that actually are using the medical coverage offered by the city. And please understand, not everyone is entitled to it. And we also want to thank you, Trustee Santos, who reached out to us with a couple of recommendations, hopefully to make it easier, either more clear to the members and to encourage them to file a reimbursement form. So he did share with us some ideas as to what we should include in the letter and what should come first. So hopefully so that members, instead of filing away the letter, they take a look at it and read it. So thank you, Trustee Santos.
And thank you for listening and putting that in action. I appreciate it.
You're welcome. We also, you may recall at the last meeting, we have issued the RFP for board medical advisor. It closes on April 15. In fact, we have an item on 4C that I want to share with you, some explanation on the disability retirement application process. I wanted to share that with you today, that discussion, because it takes into consideration the medical board advisor position. So I want to share that with you. We will discuss that in a few minutes. And then in closing, I wanted to let you know, you saw that we included a copy of the presentation of the actual evaluation results that we made to the City Council last month. It has taken me about 7 years to condense the presentation from about 20 slides to 5. I think I finally got it down to the number of slides that are needed. In a nutshell, I provide the City Council with, here are the results. This is the funding ratio. These are the city contributions that are due. These actually, there's a slide that also include expected city contributions for the next 10, 20 years, assuming that all the assumptions are met. And then I include a slide that, to be honest, we don't include that slide in the presentation to the boards, but I really think that is an important slide, and I have spoken to Kyron about it. It's really the one slide that explained the actuarial smoothing process, whereby you smooth out the returns over a 5-year time frame. And so I wanted to share that with the City Council so that they knew that, for example, for police and fire, there are over $100 million still left on deferred losses to be accounted for going forward. I think that's a critical piece of information to be shared with the City Council and your boards. I think Trustee Sinceri asked me, what were the comments by the City Council, and I purposely left this item at the end so that when Trustee Foley comes forward with her comments, she can share her views on that. I certainly don't want to speak for the City Council, but let me just start by saying a couple of things. It was a very long meeting. The City Council spent about 5-6 hours discussing the budget message by the mayor. So by the time we got to speak, it was close to 8 o'clock at night. So I'm going to suspect that that has something to do with the limited number of questions that we received. But there were 2 items that were asked. One of them, and you may recall, was the fact that the city elected to pay the full contribution on the OPEB, even though the contribution calculated by Kyron went over the cap that was agreed to by with the unions. The difference was close to $1 million. So that was, the question was asked, and I explained, well, the cap was about 27.3 million, and the city is expecting to pay about 28.3. That was one. The second comment that was asked was in reference to the actual, which you don't have here in front of you, the memorandum. They wanted to make sure the memorandum was a little more user-friendly. So I agreed to meet offline with the council member that made the comments so we can get some input, how we can make the memo a little more user-friendly for stakeholders. Other than that, I don't recall any specific questions. I fully expected some questions in reference to the projections for the contributions, but again, it was a relatively quick discussion. So those are the comments that I have for you this morning. I'm happy to answer any questions. And of course, I encourage Councilmember Foley to comment, obviously from her side, how the council felt the evaluation presentation that went at the meeting last month. So with that, that concludes my comments, Mr. Chair.
Well, thanks, Roberto. Floor's open. Anybody have any questions for Roberto before we go to Councilman Foley? Pam, take it away, all yours.
Kind of leads me into my first topic, which isn't Roberto's report, but it's a discussion that we had just Tuesday on making our meetings more efficient. Our meetings run really long. We sometimes get in the weeds on topics that go, we get into this rabbit hole discussion sometimes, and council members can go on. And what that results in is, in the beginning of the meeting, that's fine. We're fresh, we're sharp, we're listening, we're paying attention to all the important details. And then as the meeting drags on, and public people, members from the public are there to speak, we start limiting their conversation and their presentation to 2 minutes to one, giving us an opportunity to actually try to finish our meeting by midnight. We had a long discussion about that on Tuesday, as you imagine, because that really the whole focus of that item was to limit council's discussion so that we could listen to the public and that we could spend more time really on the items that are really important. Because what happens as we get to 11, we still have 3 or 4 items left that are big ticket items. They could be housing issues where we're funding unhoused programs worth millions of dollars. And because we're so exhausted and we're hitting 12 o'clock, midnight, we speed up the discussion or the staff presentation. So I think Roberto's absolutely right. By the time we got to his report, we did have the mayor's budget message, which is really important. And we had a lengthy discussion over that. But by the time we got to him, his report was really well done. It was in previous years, frankly, Roberto, it's been a little confusing and the 5 slides were not as confusing. So I appreciate that. I think the explanation over smoothing was really helpful. And the full contribution discussion was important to have as well. And any way you can simplify the report with, I think it was Council Member Mahan who made that suggestion. I think that's a great idea. So I think your report was well received. I haven't heard any feedback one way or the other that it wasn't. I found it very succinct, to the point, and helpful, and it passed without dissent. So we did approve, getting back to the initial comment I raised about making our meetings more efficient, we did approve a method in which we are going to attempt to do that. And we're going to run that through the end of the year or the end of the pandemic and virtual meetings, because we think things may change a little bit on how we maybe conduct business once we meeting in person. It's really hard to have the collegial relationship we have virtually. And when we get in person, I think it'll be a little bit different. So we'll see how that goes. Those are 2 of the things I wanted to talk about. The other thing is I wanted to let you know, I'm sure you already know, that we did select a new police chief. Anthony Mata was selected, and he has taken his position, I think, a week ago. Although I could be wrong about that. I think the 22nd of March is when he began his position. We are in contract negotiations with all of our bargaining units, which includes PD. Mayor's budget message was really interesting. We are facing a $48 million shortfall. That's economically driven, of course, based on COVID and people not staying in our hotels and convention centers, and the TOT tax that we're not getting, and the sales tax is reduced. But there are efforts in place or through the budget that will assist small businesses. Al fresco was extended through the end of this year, so businesses will be able to operate outdoors within limitations through the end of this year, which is good because it was set to expire. The mayor's budget also calls for us looking at the way we do business with our employees. You know, we have a small staff. We all know we have a small police department, we have a small fire department, and the rest of our staff is small as well. And we ask them to do so much, and even more as it relates to the last year under COVID. So working virtually has given us an opportunity to analyze how we do business and whether there are ways that we can streamline activities that we do that would make it more efficient for our employees and our residents too. So that was a part of the mayor's plan budget is to take a look at those. Maybe that will require consultants, probably an investment in IT to make sure we can work virtually. We're not going back to City Hall yet, and I don't know when we will, but hopefully in the next couple of meetings, I'll have a report for you on that. We're all wondering when that's going to occur. If you haven't got your vaccine yet and you can, please go out and get it. And now if you're 50 and older, you can sign up as of today. So please go out and do that so that we'll all be safe. Because we have a thin staff and our staff is overworked, we in previous years set priority setting. And in priority setting, council members come up with these great ideas, what we think are great ideas, and things that we should be doing at the city. And then as a council, we vote on them. And those items that get the most votes are the things that are assigned to staff to then come up with a plan at how we're going to implement. This year, we were asked to take a look at bring in 2 priorities, and then we created instead a roadmap. And the roadmap included a list of the things that were backlogged. Those backlog things included things that were already set as priority items, but then stalled because of COVID. So in the roadmap, we were asked to select, we came up with 2 items to move forward, and I'm happy to say that my item was the #1 vote getter. It was merged with another council's vote getter. We got 10 out of 11 votes, which was really exciting. And it has to do with our homeless population and resources and how we're going to deal with encampments and sanctioned encampments and relocating those unhoused who are living in really environmentally sensitive areas along our creek beds, how we're going to relocate them to other areas, and also provide additional resources to them for example, porta potties, trash pickup, showers, mental health services, addiction services, so mental health counseling, also job skills and such. So the budget will include additional funding for that, but that was the #1 item that was approved by council, and that will go forward. The idea is really to get the unhoused away from our public right-of-ways and from creek beds, and creating areas that we can treat our unhoused humanely, but provide them services they need, that we can do that. Because we can't obviously provide porta potties for one unhoused person, and we can't have them on our creek beds. We've been fined for that. We have lawsuits. I know Trustee Santos knows all about this, because we partnered with Valley Water on cleanups and abatements, and thank you for that you're increasing some of the abatements along the creek beds, of which I have a couple of creeks in my district. So, I could go on and on about the budget. The last thing I will say is that another thing that we approved, and this isn't really related to anything that you're doing, but it's on a lot of people's minds, and that's the sideshows. If you live in San Jose, or actually any city in the county and around the Bay Area, you're impacted by sideshows. These are activities where 200, 300, 400, 500 vehicles go to one major intersection within the city of San Jose, and they actually block intersections so police and emergency vehicles can't get through, and they're highly dangerous. There was one on Lee and Hamilton about a month or so ago where there were a lot of guns fired and a lot of shell casings discovered shortly after that. But what happens then, the police are called, very dangerous situation for police. The police are called, and then they're taken off duty in other areas in order to respond to these sideshows and street racing that we have. So on Tuesday, we instructed staff to come back with a promoter ordinance. Right now, if you're a spectator at one of these, you can get a ticket for observing. Now we're going to go after those who are promoting it. We're going to work on a task force that will be Bay Area counties wide to try and resolve the issue. Recently, we just heard a report from Captain Trayer, who talked about the amount of citations that are issued to observers, and the observers, we have numbers of 47% are only from the city of San Jose. 53% of those who receive citations from as observers were from other jurisdictions, like as far away as Los Angeles. So this is a huge problem. It's very dangerous, very disturbing to the communities. I live about a block off Almaden Expressway, and I hear the cars going down to Almaden Expressway in Hillsdale. Very dangerous. So we're going to beef up the police, allow more overtime, figure out a way to handle that a little bit more effectively. And then we're also looking at street improvements to narrow the streets, to take away the attractiveness of some of these intersections. So with that, I think I've covered everything. With that, I will conclude. I know this report for me was a little bit longer than normal, but there were a lot of things that I wanted to let you know about.
I always appreciate the depth and thoroughness of your reports. As we just set our goals to try to figure out how much pain the city can tolerate and how much gain we can give to it. So it's kind of important to know what the city's doing. You are after all why we're all here. Any questions for Councilwoman Foley?
Yeah, Mr. Chair.
Sure.
Dick Santos. To Councilmember Foley, I want to thank you for your comments and all the work you're doing. I won't say any more because we're doing this meeting here, but they're very appreciative. Thank you.
Thank you. I appreciate that.
Yeah, thanks, Dick. Anything else for Councilman Foley? If not, back to you, Roberto.
Great, thank you.
Thank you, Mr. Chair. So I think the next item is have to do with the disability discussion. Michelle, if you are kind enough to bring the one page to the screen on the disability steps.
Sorry, just give me one moment. I'm having trouble.
Well, Michelle, get the one-page document. I wanted to bring this discussion forward to your meeting, and I don't know if many of you can see Council Riquera, our Youth Disability Council, is also here this morning with us in case there are any specific questions. Thank you, Michelle. So the reason I wanted to bring the disability process before you, the intention is not to go through each one of the steps, although if you have any specific questions that you want to raise, feel free to do so. The reason for the discussion this morning, as you know, in my other report, I mentioned that we just issued the RFP for a board medical advisor. I wanted to take a few minutes to speak to you about that because about 3 years ago, we did go through the process of issuing an RFP for board medical advisor when the city decided to disband their area or their section that was led by Dr. Das that provided some medical reviews, not only for your board and disabilities, but for the staff of the city and all the members. At the time that when we issued the RFP, we were lucky. We found one board medical advisor that actually bid on the project, and this person actually has experience on working as a board medical advisor for other systems in Northern California. He only worked with us for about a month before resigning, and at that point we were lucky, extremely lucky, to come across Dr. Tierman, who actually was a doctor for the city before Dr. Das, and then continue her work with a medical doctor for other institutions, including some pharmaceuticals. And so we were so lucky to find someone that not only understood the city process, but really understood the disability process, as she was involved with it many years before. And so she's been an outstanding, I don't want to speak to that. I mean, Trustee Lanza and Trustee Santos can speak to you about the kind of work that she does, excellent work, providing reports to the boards. Now, while we're here this morning, I have shared with you that I'm a little concerned that we may not be successful this year, actually finding doctors to bid for the board medical advisor position. If we are successful, and we do have some bids, and we do hire a couple of doctors, I just wanted to share with you, it will take some growing pains on sharing with the doctors and teaching them about the disability process. And so I want not only the committee members to be aware of that, but also your board to be aware of that, because it will be hard for them, for the committee and the board to expect the same kind of work that Dr. Tiemann used to do, even though we will share with them prior reports, and we will certainly try to be as helpful as we can, and as onboarding them in the process and what is needed. Now, the other possible option is that we may not get any board medical advisor bids, and so we're not able to fill that position. And if that's the case, what will happen is that the committee and your board will no longer have a board medical advisor report to rely on, and we will be relying on the independent medical evaluation, the IME report, which, as you can see, on the list of the process, we do receive that already. So I just wanted to make sure we have, again, your disability counsel, Rose Riquera, here this morning. We also obviously have the general counsel, Harvey Litterman. I think they can both tell you that there are other jurisdictions in California that they do not function with the board medical advisor, and they do rely on independent medical evaluations, IMEs reports, for their decision making. So again, the goal here this morning was sort of to compare and contrast, sort of let you know what the process, disability process is all about, and share with you the possible implications of the current RFP that could have in your disability application process going forward, depending on whether or not we are successful actually having bids for the project. So with that, I'm going to stop my comments and sort of open it to the trustees for any comments or questions that they may have.
Thanks, Roberto. Floor's open. Anybody want to jump in? Dick, do you want to make any comments?
Well, yeah, I was hoping this would be under my report, but it's no big deal. I really appreciate what Roberto's done. Let's go to Russ Roqueta first, and then you, Drew, and then I'll finish up.
Great. Yeah, good. Russ, do you want to make any comments?
Sure. I look forward to any additional comments Harvey might be inclined to provide. I think his scope of representation exceeds mine. But with respect to my California governmental defined benefit plan clients, none of them have the equivalent of Dr. Tierman. As Roberto described, they all only have IMEs. Most of them use one sort of organization that contracts with different specialties, and the physicians in those specialties prepare the IMEs. And staff and I do our best to educate the various physicians as to the particular issues that we want them to focus on. And they're basically similar from system to system. And they're basically, with some variation, similar to uh, the questions that are appropriate for the police and fire system. And normally, the reports are adequate. Sometimes it's necessary to go back to the physician. And at least for one client, the process works in 2 waves. The first wave is that the records, and only the records, all the relevant records that have been accumulated, are provided to the outside specialist who prepares a record review. And for that client, if the record review comes out in favor of the applicant, then the application is put on the consent calendar for a forthcoming meeting of the board, and the board members, of course, are always able to take that item off consent. If the record review, however, comes out against the applicant on one of the dominant issues of incapacity or service connection, then an examination is scheduled with that physician, and the applicant attends that. For non-orthopedic conditions, a Zoom call has, over the last 12 months, proved satisfactory. Then on the basis of that examination, the examining physician will issue a supplemental report, and often that supplemental report repeats the conclusions that the examiner came to as a result of the record review. So the process works adequately. What will not be the case generally, unless we make a significantly large issue about it, is that the IME will not provide the sort of medical education on the specific condition or disease at issue that you may have grown accustomed to in Dr. Tierman's lengthy and for me, very helpful reports. That element, that is a very significant element of her reports, will not be present typically in any of the IME reports, either assuming San Jose follows a similar practice in either the record review or the post-examination report. That is a drawback, but the other systems still, I think, comply with their fiduciary duties with respect to evaluating the applications and coming up with appropriate decisions, even in the absence of the kind of reports that we've grown accustomed to from Dr. Tierman. And another obvious issue is that Dr. Tierman or her successor can, in a sense, educate IMEs, and doctor-to-doctor communication might produce better understanding on the part of the IME. In a context without a board medical examiner, then it's lay people doing the best they can, though usually the outside vendor can also help. But as is probably clear, without a board medical examiner doing a summary, each time we go to a new specialist, that specialist has to be brought up to speed on San Jose's requirements. I hope I haven't gone on too long. I apologize if I have.
Let me weigh in. No, Russ, I don't think you've gone on too long at all. Let me sort of put a fillip on that. So the board's probably thinking, well, okay, everybody else does this. Why don't we just do it? And here's the problem. There's a twofold problem in the disability system at San Jose. We identified this years ago. One is, two like this, and one is like this. The first is both the police department and the fire department of San Jose have an all hands on deck policy. And that means there's no gray zone when you're 45 or 50 and you can't quite do the work. There is, but it's not official. And so we really demand a higher level of physical performance from both our police and our firemen than most other systems do. And it's further exacerbated by the fact that a lot of other systems have, all right, you've been injured. Hey, we got a desk job over here. Come and sit on this desk and, take your years of experience and help us out while we see if you'll medically improve. And we really don't have much of that at San Jose. So we have this enormous problem at San Jose where we expect a lot physically of our policemen and firemen. And when they can't do it, we're inclined to say, hey, what are you going to do? And so into that gap steps a large number of disabled people, right? And it turns out that a large number of the disabilities we see are the kind of disabilities we're all familiar with. It's a bad back, a busted knee, a bad shoulder. And I think a lot of other systems would sort of accommodate that either by, well, he can keep working, but he's not going to haul hoses up a stairwell, or here's a desk job. And so the work that we get from Dr. Chairman is absolutely vital, because putting a fillip on what Russ said, we operate, I think, a lot more in the gray zone for a very good reason, and we need help in the gray zone, and that's why we need a board medical examiner. That would be what I would say. Thanks, Dick, for hearing me out.
Well, thank you, Mr. Chair, and thank you, Russ. I want to say to staff and Roberto, thank you for these 2 pieces of paper about the applicant's application and the disability process. This is very helpful. In fact, if we can send those out to the POA and Local 230, that would be very helpful so they can read some of these things. These are very good updates so they understand the process. Everything that Russ and Drew said is on the money. The biggest question is going to come up when Dr. Chairman leaves. It's all about cost to this retirement system, potential future benefits, and the fundamentals of running this system. So I question that. Drew questions that. Russ is on the same board, and Russ brings you experience from other cities along with Roberto. I would say we should review that other examples of how other disabilities. We don't have a high rate of disability in San Jose. That's a presumption by reporters and people who want to be critical. That's not correct. So all I can say is this: I'm a fiduciary. I want to see cut costs. There's programs that the city must look into in terms of healthcare to help prevent these disabilities. But that's another issue that Ms. Foley can address and other people. All I know is this: we're here to serve. Our men and women are putting their lives on the line, and we wish them nothing but the best. The panel we have, I can tell you, I've been around for 54 years. It's a wonderful panel. They do a great job, and we're saving costs, and we're helping the applicants and the city of San Jose. So I'll leave it go at that. Thank you.
Yeah, thanks. Floor is open. Anybody have any questions or comments?
Hi, Drew. I got some questions, if you don't mind.
Oh, go ahead.
And this is probably directed to Roberto and
Prabhu will be fine. He'll take care of it.
Yeah. In regards to the process, can you go through the timeline of the RFP, how long it's going to be out for? If we do get an applicant that applies for it, how long will it take to vet them? Knowing that Dr. Tierman is leaving, was it June or July?
So Dr. Tierman, I think contract runs out June 30th.
Okay.
I believe the RFP closes, on April 15th. But luckily, we have Barbara at the meeting, who is leading the charge on the RFP. So I'll turn it over to Barbara to address those questions. Barbara?
Yes, April 15th, the RFP does close. We will be making the assessments in May and coming with a recommendation anticipated for the June meeting, the June Police Environment.
Okay. And Roberto, when we started this conversation, there was some hesitancy that the RFP might not be successful based off of past experience. I know when the cities put out the RFP for the medical panel, we've always been struggling with that for multiple years due to the description and qualifications for it. Is there anything in this RFP that gives you the reluctancy that we might not be able to pool as many applicants as we would hope?
So let me address that. So two things. First is because 3 years ago, Trustee Gardiner, we had a very difficult time trying to find a medical board advisor. And as I indicated, we did find someone who quickly decided to quit on us. I believe, I'm not really sure if he still does this kind of work for the other jurisdictions. But the second one, I think it goes to the comments by Council Riquera. I think he actually mentioned that the jurisdictions that he worked with, they don't actually have a board medical advisor. They rely on the IME. So I think it's the fact, Trustee Gardenier, that this position of board medical advisor is not usual in the jurisdictions. It has been in San Jose because historically, as you know, there was that position by Dr. Das. And that's why we had that position, but that is not the norm across other systems in the state. So that is the main reason why I want to create clear expectations for you, board, in the event that we are not able to be successful, because I just don't feel very positive about it because of those reasons.
And I completely hear you. And that's, I mean, there's two things that I'm looking at is, okay, how successful is this RFP process going to be? And if we are not successful, how is this going to affect our members who are going through the process? And what can we as a board and staff do to still make sure the process doesn't stop? I know, 3 years ago when we did hire that one medical advisor that stuck around for a month and then left, I think the process stopped for almost 6-8 months where not much was done. And I believe at that time, then staff came with a recommendation that, there's some files that we could be able to push forward, but there's some that will not be able to. And so I want to make sure that Dick and Drew and the committee, along with staff, starts thinking about contingency plans in case we don't have someone in place, and how we could keep the process still moving. It might be slower, but still moving.
Very, very good question, Trustee Gardenier. And so our goal, as explained by Barbara, is to come back to you, board, in June. One or two things. Either we'll have a successful RFP and have some recommendation to do the work for a board medical advisor, which, again, I would expect it to be, if we do find someone, that there will be some growing pains. Or if, as we suspect, we may not find a board medical advisor, we will come back to you, board, in June, sort of to reevaluate this process and sort of let you know that, honestly, I wouldn't really expect any delays or strong impact to the membership. I actually would think that the more growing pain in that situation will be for the committee members and the board members to start getting accustomed to making decisions without having the board medical advisor report, which in fact may even do two things: accelerate the process because there's one less report to go through, and in fact, from the administrative standpoint, it will decrease the administrative budget, the annual budget, because it will not include board medical advisor fee. So that is not what we are saying this for. It's not because we want to save money. The main reason for this discussion this morning, and I want to thank you, Trustee Gardenier, for raising this issue before, is so that your board has clear understanding and expectations of what may be the impact to the committee and to the board in the event that we are not successful on the RFP. That is the main reason. But I don't, either way, I don't expect it to have any critical impact on the process and the members. If anything, if we do find a board medical advisor, it will be maybe, it may limit or it may extend the time frame of the disabilities at first while we're trying to onboard the new members that are providing this service to the committee and the board. That will be on one side. On the other hand, if we are not successful and we basically do not have the step of the board medical advisor, it will be a situation where if you look at this summary of process, we will be deleting that particular step. We may have to be a little more specific on the information that we require. We request the IME, but again, in that case, the impact will be more to the committee members and the board getting accustomed to making decisions based on the IME report without the board medical advisor, but not having a direct impact to the process for the members.
Okay, I appreciate the update and bringing this topic to the agenda. Thank you.
Floor still open. Anybody else have any questions or comments?
Yeah, Drew, I have a question. I think this is probably not the scope of, of this board, but I was just curious about the all hands on deck policy. What is the thinking? Is there benefits versus costs, I guess, I guess in theory, somebody who cannot do the normal job, being on a desk probably saves the city some money, right? I mean,
yeah, it's been so interesting. I mean, we talked to folks about this before. It's just the way they run the city, and I think going back to when you were on duty, right, Dick? It's if you can pick up a hose and fight a fire, pick up a hose and fight a fire, right?
Yes, Drew. There's no use for you and I talking about the cost anymore. We've went over this stuff a million times. It's up to the city and the bargaining units to work that out. Yeah. I wish they would. To me, there's a simple solution here. There's other plans that do this thing, and it's not as costly. And the panel would review this stuff, and if we had a question, we could farm it out and save money. But it's up to the city. We have already talked about this. I've met with the city managers in the past. I've done everything I can to try to make that playing field as level and as prevalent as possible. So that's the end of that for us.
Yeah, it's a frustrating. You sort of hit the nail on the head. It's a frustrating process because it's kind of broken, and we're the bottom of the heap. So we got to deal with the broken process and broken people, and it's not fun. Which is why we could. The board used to hear these cases, and that was dysfunctional. So we split it off into a committee, which I agree with Dick. The committee is very high function. Floor is open. Any other questions or comments?
Drew?
Yeah, go ahead, Russ.
Russ here. Just wanted to comment on that, but not on the policy elements of it. And Harvey may have a broader view on this than I do. But with respect to my clients that have police and fire, they all have this requirement of ability to do the full duties of the job. And if that's the standard, then even a comparatively minor disability that results in permanent work restrictions compels a conclusion of incapacity, so satisfying that element of the disability retirement. And all I mean to say is that San Jose is not unique in, or the San Jose Police Department and Fire Department are not unique in having this very high standard, as a result of which many applicants are found to be incapacitated in situations where perhaps lay people would be surprised at the conclusion of incapacity. That's my only comment.
That's helpful. Thanks, Russ. Floor still open. Anybody else want to comment on anything? You want to close out your section, Ruto? Any final comments on this or anything else?
No, no, no. Well, quickly, just I want to thank you again, Trustee Gardenier, for raising the issue again, and I just again I want to keep the board apprised of what are the implications of this RFP, and we will come back in June one way or another. We will certainly give you an update in May if we receive any applicants. And in June, we'll come back to sort of finalize this concept, in whichever way it may falls out. So that's it. I don't have any other comments or questions. But in the meantime, if any of you have any questions or requests related to this process, feel free to reach out to us, and we will address it. So thank you, everyone.
Great. Thanks, Roberto. We're on to section 5 on service retirements, and then we'll also have death and survivorship notifications. So I'll read these off and then entertain a motion to approve. Jaime Almar, sorry about that, Jaime. Police officer, police department, effective April 3rd, 2021, 25.03 years of service. And Todd A. Cleaver, police sergeant, police department, effective March 26th, 2021, with 28.03 years of service with reciprocity. Jeffrey P. Facio, police officer, police department, effective May 1st, 2021, 26.21 years of service with reciprocity, and the specs of the reciprocity are there. Philip D. Garcia, police sergeant, police department, effective May 1st, 2021, with 25.07 years of service. Gary L. Garrison, police officer, police department, effective April 2nd, tomorrow, 2021, with 26.73 years of service, with reciprocity, and the specs of the reciprocity are there. Donald Esguerra, police officer, police department, effective April 3rd, 2021, with 25.03 years of service. Victor E. Loesch, fire captain, fire department, effective April 3rd, 2021, with 25.69 years of service. Luis E. Lucero, police officer, police department, effective May 1st, 2021, with 25.57 years of service. Troy K. Sermons, police officer, police department, effective April 3rd, 2021, with 25.03 years of service. And James E. Human, police sergeant, police department, effective April 3rd, 2021, with 25.03 years of service. That's one of the few times everybody made it over a quarter of a century. Do I have a motion to approve these?
Santos approved.
Santos approved. Do I have a second?
Muyo.
Muyo, second. Let's go around the table. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Eshvar?
Aye.
Muyo?
Aye.
Yes.
Santos? Zuri?
Aye.
And Lanza, I vote aye as well. I don't know, Nick or Dick, do you want to say anything about any of these gentle people?
Well, let's do for Andrew and Nick, please.
Good. Andrew, Nick, you want to make any comments?
Yeah, I just want to say thank you for everybody for their service. You know, it's I know it's a time that everybody looks forward to and gets excited about. It's the retirement. Hope that everybody is healthy. But thank you for your time and service to the community.
And from the police side, just to echo Andrew and Dick's sentiments as well. Wish them good health and good fortune in their next career choice.
That's great. Thanks, gents. Now we're on to death and survivorship notifications. I'll read these off and then we'll have a moment of silence. Notification of the death of Truman Bowman, police officer, retired June 26, 2010, died December 20th, 2020, survivorship benefits to Barbara Bowman's spouse. Notification of the death of Merrill Malvini, fire captain, retired February 5th, 1986, died February 20th, 2021, with no survivorship benefits. I always read through the details of these. I'll make the odd point that Captain Malvini entered the service the month I was conceived. I hadn't even been born yet. So good for him for living a nice long life. Notification of the death of Gregory Toscano, fire engineer, retired November 15th, 2008, died February 9th, 2021, with no survivorship benefits. And notification of the death of Jeff Shackelford, fire captain, retired April 3rd, 1984, died November 6, 2020, with no survivorship benefit. We'll now have a moment of silence. Thanks, everyone. I don't know, Andrew, Nick, Dick, if you want to comment on any of these folks.
Santos here, Mr. Chair. I worked with all three. I thank them for their service and the respect and peace goes to their families. Thank you.
Thank you. Anything from you, Nick?
Yeah, I worked with Bud briefly. I guess when your name is Truman, you look for a good nickname. His was Bud. But a quiet confidence about him, easy smile, just an easygoing guy. When you got 8 or 10 guys lined up behind you waiting to bust through a door, Bud was always the guy that would step forward and check to see if it was locked or unlocked. Really sorry to hear of his passing, and all the best to his wife and his family. Thanks very much, Drew.
That's great. Thanks, Nick. On to committee reports. The investment committee, any oral remarks, Ashfar?
No, I think most of it was what we discussed at the board today, which is about the strategic asset allocation.
That's great. Let me note that we received and will file the minutes of the February 23rd meeting. Howard, anything to comment on the audit risk committee?
No, we discussed the last meeting from February at our prior meeting in March, so no updates.
That's great. I noticed onto the governance committee, Nick Muyo, I noticed we've got something here to take action on. So go ahead, Nick. You want to drive for a minute or two?
Can you move it up a little bit, Michelle? Thank you.
Or Roberto,
Nick, if you like me, I can speak to this. So this item was discussed at the joint meeting last time, and if you recall, most of these governance policies and charters were initially established in a 3-year time frame for review. This new frequency actually extend that time frame to 5 years, and but that does not preclude you board for in any particular point in time bringing a particular policy or charter for review if there's need to be. The memo speaks for itself, and so I'm happy to address any specific questions. But the decision of the committee was to support the recommendation, and as such, to recommend to your board to actually approve the reducing the required frequency of the review.
Great. Floor's open. Any questions on this issue? If not, I'll make a motion that we accept the recommendation of the governance committee to extend the review period from 3 years to 5 years. Is there a second to that motion?
Second by Santos.
Second by Santos. Any further discussion? If not, Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Ashfar?
Aye.
Muyo?
Aye.
Santos?
Yes.
Sanzeri?
Aye.
And this Chair Lanza, I vote aye as well. And for the record, let me note that we've received and filed the minutes of the December 17th, 2020 Joint Governance Committee meeting.
And
okay.
Drew,
Go ahead.
Yeah, I
Sure.
just wanted to let everybody know that as you may recall, Tom Iannucci has also been working on aligning the policy and procedures manuals between the two boards. We were up against a hard stop of 3 p.m. when we last met, and there was a lot of wordsmithing on what Tom had done up to that point. So it's basically been tabled. He's going to continue working on it. Hopefully we'll be able to finalize things at our June meeting and have it for the board for approval in August.
Oh, that's great, Nick. Thanks for keeping it up to speed. I know how much effort has been put into that, and I think that's just great.
Yeah, thank you.
We didn't have a disability committee meeting. Is there any remarks you want to make, Dick?
No, just the panel does a great job. We'll have one hearing on April 5th at 10 o'clock. We have one applicant only. With that, I thank you for all the information that was provided today.
Thanks, Dick. And the final report, Joint Personnel Committee, Vince, anything to comment on?
Just to let you know that the Personnel Committee has an ad hoc committee that has been created for some time, working on trying to finalize the evaluation procedures for the CEO and CIO. And I think we are close to having a document that we can take back to the committee for approval and then the full boards.
Great. We're coming up on the very final piece here. As always, if you have any proposed agenda items, feel free to send them to me or Andrew or Prabhu or Roberto or any member of their staff. We keep a pretty open agenda. Anybody from the public have any comments to make?
Yeah, Mr. Chair.
Yeah.
Santos here. I'd like to comment, you know, during this C-19, there's many tough times out there and we have a lot of challenges, but I just want to say that, you know, the police and fire has always been there, continues responding. Our government continues to work. It goes to show you when we work together, things can be done. So thank you all.
Yeah, well said. You know, Dick, I think San Jose has fared well, and I think relative to other cities, I think it's a compliment to the caliber of the citizens and also the people that help keep the city safe. That's it. I think, folks, we're done here at 11:15. See y'all in a month.
Stay safe, everybody.